Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, February 10th. It is 4:58 p.m. Eastern Time. I'm coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Ugly day in the market today. Let's get right into it. Our state of the market. We're still in an uptrend, but it got more tenuous after the ugly action today. Let's check the trend gauge over here. We've still got leaders at neutral. 20 of the 21 stocks in the 21 over 21 list still above their 21-day moving averages. So leaders holding up okay, or what appear to be the leading stocks in the market, not making a lot of progress, but still holding up. So we've got a neutral there. Short term, if we could have got a second close above the 21-day moving average today in the NASDAQ 100 and in the S&P 500, we would have went to neutral, pointing toward bullish. But we had a big gap down this morning, nice rally mid-morning, and then smack down early in the afternoon. So we're staying bearish / downtrend on our short-term moving average. This basically is answering the question, what are the 5 indexes doing versus these moving averages? Medium term, we've been bearish for quite a while, all the way back to 118. And long term, 121, we're at neutral, as we're struggling with the 200-day moving average on some of the indexes. Also, we're going to get all into these charts momentarily. So what happened today? The title for today is Poor Action Equals Expectation Breaker. Now, you won't hear me predict here. I usually try to present just the facts, but we certainly do have expectations for how the market, based on how the market is behaving, should it continue to behave that way. So if we're in a bullish posture, my expectation is that the market should continue to act well. The indexes should hold support. Leading stocks should go higher and outperform the averages. But this morning at 8:30 a.m., CPI came out and it signaled that inflation is not waning, and it resulted in a gap down of between 1.3 and 1.9% on the major indexes. So started off bad, but that put in the lows immediately. We started rallying pretty much most of the morning. We were at the top of the range when I break down the 30-minute opening range every day. We're at the top of the range after 30 minutes, and then we actually got to flat. So we went from down 1.3% on the S&P to flat. And then one of the Fed guys, Bullard, came out and said that he thinks we should see a full 1% interest rate raise by July, and the markets were not ready for that. And a harsh reversal, a little bit of a bounce, and then made lower lows on the day into about the last 15 minutes, where we saw a little bit of a relief rally off the low. So poor action equals expectation breaker. We got more defensive today as a result of that. The G6 growth index down 2%. S&P 500 ended up down 1.8%. So from minus 1.3 to flat to down actually over 2.1, and then a little bit of a rally down 1.8. NASDAQ 100 down 2.3%, Dow down 1.5, mid-caps down 1.5, Russell down 1.6. Broad diversified pie chart, 60-40, world and U.S., 60% stock, 40% bond, down 1.17 today, as CPI did spark interest rates higher. Our flagship portfolio, GROTECTION, down 1.31% on the day. So let's get into the charts and the tail of the tape. First, let's get into the team here at Revere. Participating in upside, protected during downside. That's our motto here. It's a common sense approach to us. It's what you do in every other aspect of your life. Why can't you apply that to your finances? Well, because Wall Street is rife with conflicts of interest that we work to overcome every day. And if you're interested in this approach, give us a shout. You can email any of us, Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. Chart time. Let's bring in our chart of the S&P 500 here. Let's take off stochastics and let's blow it up a little bit. So here was, I talked about how this pattern, while we were consolidating on Tuesday's video, I talked about how this pattern resembled an island pattern in the COVID, during the COVID recovery, where we had a sharp move up off the bottom, pulled back, stabilized for a while, looked like we might break down, but we didn't. We had a gap up follow through day, and this 2-9, this Wednesday candle looked exactly like that April 4th, 2020 follow through day. It was a subsequent follow through day, higher volume, good action on leading stocks as well as the indexes. So everything's fine so far. Expectation, back above the 21, break out of this range, still below the 50, understood. But let's see what CPI comes in with, and it just smacked us down. And then Bullard's afternoon comments sent us even lower. Let's look at a 5-minute chart of the S&P 500 here. You can see. So here's the gap down, back by 10:45 Eastern, 45 minutes in, we're back to flat. A little bit of a pullback. We're rallying, try to get that back, and then here we are at 12:45 Eastern. Bullard runs his mouth, and then it was just a chop lower into the close. 44.84 is the low. Closed at 45.04. Let's go back to the daily chart here, and you can see undoing our move above the 21. And now we're back to monitoring, is the 200-day going to be support? Are we going to get back above the 21? Or what's going to happen with the overhead 50-day moving average that we've failed to get above? So that's what I'll be watching tomorrow. Are we going to have further weakness? And if so, how are leading stocks impacted by that further weakness? Are they holding up? Are they breaking down? And we'll position ourselves accordingly. Let's go to the NASDAQ 100 before I pull up the tail of the tape, because we closed just a hair above the 200-day moving average, and we closed above the 21-day moving average on the NASDAQ 100 yesterday. But we had the gap down, but a very nice recovery. Where did this recovery stop? Right near yesterday's highs and right at the 200-day moving average. When we started to roll over there, we put the first piece of the hedge on against the NASDAQ 100 and against our longs when we failed there. It's just a low, at that point, it was really just precautionary, just a low risk move. We had some nice alpha on the day. We added to some positions, which I'll talk about in a moment. And then we started rebounding, so it looked like it wasn't really going to be needed. And then this 12:45 candle came, and we headed lower into the lows of the day. So we failed at the 21, we failed at the 200. We do have this hedge on. Let's see where that continues. And that's offsetting our longs. I'll go through the portfolio here momentarily. Let's bring up the tail of the tape and go back to the S&P 500 so we can just get our bearings here. Been talking for a while about the headwinds, no change there. VIX up 20% on the day. Our bull case, the follow-through day holding, leaders emerging, back to tenuous in there after looking good yesterday. The news I mentioned, CPI, showed inflation is not waning. Rates went up. Then the Bullard hawkishness support. What I was watching was the S&P against this 21, close above it. Could we get a second close above it? Nope, broke support, so that's a negative. Notes QQQ, QQQ rejected in the 200-day, and the SPX failed at the 21. And the bottom line here, negative action is an expectation breaker. That's the big takeaway from the day. Portfolio, we added Datadog on its gap up. We added to our ON position, put a big hedge on with QID, took some profits on DVN, and our profit on Bros, the last piece of Bros, was back to about break even. So we sold that out too. So big decrease in our adjusted beta, adjusted exposure to the market from 1.27 to 0.75, primarily because of this QID hedge. So let's look at the levels here on the S&P and see we closed yesterday up here, all the way up here, prior close, but broke the 100-day prior all-time high, the declining 21-day, the 80 MA, and we're sitting right at 45.04 at the top of this prior pullback range that we got above on 2.9 when we had the nice gap above there. So keeping track of where we are with the levels, 75% of stocks do what the overall market's doing. We stay in sync with the leaders. We stay in sync with what's going on with the indexes. This was not a good day for the indexes. So bottom line it, again, negative action is an expectation breaker. So there's your S&P 500 with the big ugly Dow candle. Let's go through the rest of the indexes now. Dow Jones Industrial Average. Big ugly candle, break the 50, break the 21, 200-day now is support there. How about mid caps? These have been showing some relative strength lately, as you can see there. Broke back below the 50 and the 200-day, bounced at the 21. IWM small caps also showing some relative strength, but outside negative reversal day, they did make a higher high. We had strength early in growth stocks and oil stocks, but negative reversal, break the 21, bounced off the 80 MA. So there's your indexes. Let's go through the trades that we made today. First of all, Datadog. This was looking fantastic. Let's bring up a 5-minute chart here. Big gap up, pulled back, did 2% buys on it, made new all-time highs after we did the second buy, and then it just pulled back. But all in all, this held up pretty well. Really good numbers on their earnings report, sales growth and EPS growth. It is still very richly valued, but we'll take the midday bar, the middle bar close, and of course, if we break below the low, we'll be out of it for a small loss. The other one, ON Semiconductor, added to this today on the strength about 15 minutes before Bullard came out and started running his mouth. That reversed, held at the 50-day moving average, so we're slightly negative on this one also. I mentioned where we added to the QID. We wrapped up our 13% Devon gain. Any attempt for this to move higher has been thwarted over the last 2 weeks, and it's really gone nowhere. So in hindsight, I'd have been better off taking 15%, so 16% in 4 days than have it chopping sideways. But you're not getting big gains in this market, so I'm not holding out for 20% gains. In this case, we were all right with 13% on it. Sold it out, and then Bros, just the weakness in the market. I know it's holding this, but if the market really breaks down, this is the one that you're going to wake up that's going to be down 5%. So second piece sold out, just barely positive on Bros, and those are the portfolio changes. And of course, the big one was this hedge that we put on the failure at the 200-day moving average on the NASDAQ 100. So let's see, what else are we still holding, and how are they holding up in the portfolio? Apple down to its 21 and its 50-day moving average today, still looking okay, selling higher than average compared to the last 7 days. So not the best action. CF still holding this with a profit. Fertilizers have been acting very well. Wide bar for this one today, however. New, we seem to got into this at the right time. 3 straight up days off this pullback and bounce off the off the 50-day moving average. So we're positive in that one too. On the other hand, Newmont Mining stocks with a bad day. This broke below the 21, down about 4% on this one. So that's probably closest to the chopping block. Blackstone holding up pretty well. Wide candle, another one that we caught off the 50-day moving average and was looking very good early in the day before the pullback across the board in the markets. And then I showed Datadog, and that's the portfolio. Any other standouts today? MU was having a very strong day before the markets caught up with it. In fact, it's 3 straight strong days for Micron. let's see. Twilio had a big gap up, but reversed into the declining 50-day moving average. So what was at one point about a 12% gain, down to 2% by the end of the day. And BTU, a coal stock, had a good day with its gap up. Arch Coal is in the 21 over 21 list. CFLT, something we've been keeping an eye on, but knowing it had earnings, it gapped up, reversed, and now after hours down another 10%. So probably have to end up taking that off of our watch list. And this was an interesting, if you hold something and it's into earnings and you hold it into the last day, you always have a chance that somebody in their media relations department might do something dumb and release earnings early. And that's what happened with Affirm. It was having a great day. It reversed and it's down 21%. This happened to me with Twitter many years ago. And always keep in mind, if you're holding something to the last day into earnings, thinking you can get rid of it right before the close, you're taking a risk that earnings might leak. It's a long shot, but it happens. So that's going to wrap it. As always, love to hear from you. You can email me, don@revereasset.com. You can phone 855-REAL-WEALTH. Big thing to watch going into tomorrow is I'll be watching again the S&P 500 versus the moving averages. Now that we're below the 21, the 200 has acted as support. Will it continue? And of course, we've got now the 50-day still overhead support on the S&P 500. And unfortunately, the NASDAQ 100, which leads up and leads down, could not get above its 200-day moving average. So we put a hedge on. We're short the NASDAQ 100. That's going to wrap it. Closing out Thursday, February 10th. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.